Welcome back to the Kingscrowd Podcast. My name is Brian Bouhelier, your host from Kingscrowd. Each week, we are here to break down the latest investment trends, insights, and different insights on the retail private markets. So we are here today to talk about a couple different things. First, one quick thing in the news that we're going to be talking about with industry insider Scott Kitun is around some of SoFi's announcements in bringing more alt and private investment opportunities to retail. Then we will be welcoming back our senior investment associate, Bouhelier-Gautreau, to be able to talk about Gigastar, which is currently raising funds on Wefunder. Let's start off the discussion. Scott, welcome back as always. We wanted to loop you in and have a quick chat on an announcement that SoFi has made over the past week, where SoFi is adding more private fund opportunities for all of its customers. So basically retail, anyone can invest in these. Some of the minimums are $10, $500. So what we're looking at is basically, what's up? A couple different funds that they've announced. So they've recently added Cashmere with the Cashmere Fund, $500 minimum, as well as Fundrise. So a lot of investors are probably familiar with Fundrise for their real estate investment trusts, their e-REIT opportunities. They also have a private venture fund where they've been opening it up to be able to allow retail investors to invest in that, as well as ARK Invest and a couple different opportunities here, and some of the private funds that they previously offered through KKR, ARK, some other groups like that. Scott, why don't you kick things off? When you see announcements like this, obviously, it's providing more opportunities for the retail investor. But what do you think about some of these offerings through SoFi?
I think it's great in the sense that we continue to expand reach and access for everybody. I think it's not a big surprise that you're seeing kind of familiar brands here, ARK Invest, Fundrise, and Cashmere. And obviously Liberty Street, I think getting into like the credit and real estate stuff as well. I think one thing that I'm just being cautious of, SoFi becomes a wrapper of Cashmere, which is a wrapper, and I'll get into what that is in a second here, but is a wrapper effectively into what, whoever was the leader of the round that invested directly into those companies. So what I would be afraid of is just the fact that, you don't necessarily know like how many times you're buying. This is a secondary. Is it marked up? What your fees are, what SoFi's fees on top of the initial fees. Like you just have to be very clear about that. And I think that would be my only hesitation. I do really like, despite some of the shit that she gets, Cathie Wood with ARK Invest and the way that they built their crossover fund. In general though, I do think that this is an extension of what kind of already exists in the ecosystem with regard to like late stage secondary access that Fundrise and Yield Street and all these groups have really kind of offered for a long time. And I think we talked a week ago or 2 weeks ago, I can't remember, on the future contracts, forward contracts, mirror tokens that Republic is offering. And those are kind of similar to, we're all just sort of getting this like expansion into alts. What I really want to see happening is direct access. That's when I think we're going to have a place where everyone has the opportunity to truly share in what private is. And that's very complicated. And there's a lot of things that prohibit that, especially at a $500 minimum. So by and large, I think it's really cool. I think it's great to continue to see access to these things. But I do think that there are some things that I would be careful and cautious of as a retail investor, knowing what the fee structures are, specifically knowing what, how this share class is being described. Is it a secondary? Is it, what round was the initial investment at? Just in general, I think that, as we see more of these private assets and private funds and fund to funds become, more of it readily available, I think there needs to be a lot more scrutiny as to what's in them and what the investments themselves are, especially for retail.
I'm definitely a big fan. I think, this is, to echo what you said, Scott, it's moving in the right direction, increasing access to more private opportunities for investors, but of course, making sure that they are looking at different offerings, reading all the details in terms of the fees, like you mentioned, that type of thing. So also interesting, if you go through some of these on SoFi, you can see the net asset value and some different potentially growth over time. So some interesting things that I will definitely be looking into a little bit more as well. But as Scott mentioned, I think we're just going to continue to see more innovation in this space and being able to open up more opportunities to retail.
Yeah, and Brian, before you jump off that, I mean, if you're going to dig into it, I might as well ask you to dig into something specific. I would pay close attention to, you talked about the NAV, I'd pay close attention to what they're quoting as returns or projected returns relative gross versus net. If you scroll down where you currently see the transaction fee at 2%, you're seeing gross net expense ratio 3.95 to 3.51. You're only paying no hidden fees, no processing fees. Yes, true, but they're assuming when you read that you don't actually know what that means. So, and this is assuming, just to be clear to people, this is assuming you're paying a 2% transaction fee. You're going to be paying, so you look at the gross versus net expense ratio. It's a lot. And that is relative to what the investment is. And this is again, I am a fan of all platforms that are getting in this space, because the more competition, the more opportunity there is. Great for retail, sure, but competition wise, it keeps the people like BlackRock and KKR a little bit honest as they enter this private, retail private market that they've kind of shunned for years. So I just want to try to keep everyone honest. My thing is this, whether it was Sweater or it's Cashmere or it's Fundrise or it's Liberty Street, all of them do have a model where they build an SPV that they then syndicate out to everyone here at a Reg A Plus deal so we can all access it. But then that is bought from an allocator or an aggregator feeder fund somewhere else. And the more number of fund feeders there are from the actual deal. So OpenAI, somebody invested in OpenAI, someone sold a percentage of their take from an OpenAI to somebody, and then they sold it to, and maybe it is Fundrise. You just have to find that out. Then somebody bought it from them and now they're selling it to you. And each one of these people has a markup, which is why you see an expense ratio get cut in half because of that. So this is the kind of thing we've got to be really careful of. And I think in the future, this is all good. This is a good step forward, but retail can't be left. It's not even holding the bag, because that's not it. It's just you're taking an amount of risk on, even if it's late stage. You're taking a certain amount of risk on for a return profile that's not all that much different than, say, investing in a good quality index fund that has liquidity. So I think we all have to have access to alts from a perspective of diversification, volatility, and so forth. But I do caution those who are doing it just to do it, that they are not going to get the same, the multi-billion-dollar exit that the company gets and the first shareholders get is not necessarily what you're getting access to here. Just be very clear about that.
Yeah. I think too, even if you look at mutual funds and ETFs in the public markets, go back to, before 80s, 70s, fees were very high for a lot of those, right? Yeah. And the trend has been just consistently down and to the right. I think Vanguard and, Bogle was a huge driver of a lot of that, of moving fees down. So I would hope, and I suspect, that these private offerings are kind of just that day zero right now, where it's cool, people can invest in them, but they're still really expensive. But it's going to hopefully have more and more innovation and being able to drive down some of those costs getting into these.
Yeah, I'm just wait till AI takes all of our jobs and they're paying us for our money. Then we'll be collecting fees. That's the treat.
Awesome. All right, well, let's wrap things up there. I think, we'll definitely be keeping tabs on just as new private market opportunities for retail comes online. We'll make sure we're highlighting those here. But I want to welcome Leah, our senior investment associate at Kingscrowd, back to the conversation. We're going to talk about Gigastar. So Gigastar is a influencer backing platform that essentially allows investors to back YouTube creators. And then typically you have tokens and kind of revenue share, but they are doing their own round. So Gigastar, the platform itself, is currently raising on Wefunder. They popped up on our radar because they actually raised nearly $1.5 million overnight. So they are up to 2.8 million total for this campaign. Leah, you did a deep dive on them. You did a pitch review. Why don't you give us a little bit of an overview of who Gigastar is, and let's get into the details.
Yes, one thing that really attracted me to Gigastar is that it's indeed kind of a unique product. Everybody just claims to be unique online. They are really one of the only platforms on which investors can back YouTubers. And what is very interesting is that YouTubers dedicate a share of the revenue to be given back to their investors on not sure about the frequency. Something tells me it's about quarterly, but it's very, very regularly. If it's not quarterly, then it's monthly, something like that. So you actually can invest into a YouTuber and see the return of your investment starting very, very rapidly. So that is kind of a new thing that is very interesting for people. And it that's kind of the upside. I feel like if YouTubers want to raise online, and right now it's YouTubers, but I have a feeling that you can so much open it to Twitch, for example, which sometimes streamers have just way better engagement from their community. That would be a big opportunity. The downside is that this is a two-sided marketplace. As we know, two-sided marketplaces kind of need to have that constant growth. So, well, based on the chart that you're showing us right here, it does seem like this chart kind of shows the amount of YouTube revenue that is redistributed to investors every month through the platform. And we do see that number is going up. So that's good. It means more and more people are investing, more and more YouTubers are coming and actually achieving higher revenues and actually giving it to investors. But from an investor perspective, if you want to invest in Gigastar, not in YouTubers, you need to remember that two-sided marketplaces are extremely capital intensive. The company already raised close to $10 million, a lot of it from institutional investors and different VCs like Belvedere Strategy Capital. And that kind of explains why it is valued at $58 million. Now, the issue here is that it gives kind of very high revenue multiple because the company is not even making $1 million in revenue. Right now, its run rate is about $72,000 a month, which gives us less than $1 million a year. So you have to know that if you invest at this round, it's not because it's not because it's not valuation that is justified based on the revenue. It's justified based on the amount of money that was raised previously. And Scott, I know that you know Belvedere Capital. Maybe you can tell us a little bit more about what is their strategy and what do you think they saw into Gigastar?
Yeah, full disclosure, Belvedere Capital is an investor in Kingscrowd as well, and several other projects that I've worked on with Ryan Sullivan. I will tell you this, they're very smart. They're very strategic. I actually know the folks at Nameless Ventures as well. They've done a lot of co-invest. Nameless has with 776 and why am I blanking on? Alexis Ohanian, Reddit. I think the creator movement is obviously I have pretty decent amount of experience in it with Songfinch. The creator movement has been a thing that everyone's talked about for going back to 2018 and Cameo, which is also Chicago based here. The problem is that creators are fleeting. The 1% swings everything. 80% of the money, 80% of the money that comes in through YouTube is from the top 1%. Cameo is an example. Almost 85% of the income that comes in is from their top 2% of producers. At Songfinch, when we ran that, we did $40 million in revenue in 2022 or 3, and it was probably 85 to 90% came from like about 100 musicians, and the other 2,000, made up the rest. So you do have to pick it right. You need to see the numbers. I suspect that Belvedere and other investors looked at this as like, well, if it's really that simple, then you just got to focus on those people, and we can kind of figure out what success looks like. All of that said, we are and continue to enter sort of this weird landscape with AI where there's going to be more people who are entering the creator economy to try to make a living or to make extra money or whatever the case, and they're going to contend with AI, and it's a whole crazy universe, which I'm not sure makes this better or worse. But I will say this, and you're highlighting it, Brian, I think right now, them relying on a framework that allows for tokenization and modernization and basically creating an entire, truly an economy around creators is what makes them different. I think that's what is drawing attention and why their valuation is so high. I think it's way too high. Anyone who can do barely $1 million ARR and ask for 60 million in today's time, maybe in 2020 you get away with that shit, but not now. It's way too high. But I do think the fact that they're a capital raising platform in their own right, raising capital here, they're being given credit for being an economy, a marketplace, not just a place for you to find creators and monetize them or whatever, like Gumroad did. So anyway, all this is to say, I do think it's really interesting. I love the idea of it. Clearly, they have a massive following. The investors and the founders are clearly savvy. They've raised a lot of money really quickly here, and they seem to have really good money. So, all things considered, I do think it's a really unique investment. I would definitely consider investing in this company. I like all of the top level stuff. Obviously, the valuation's not my favorite. I don't know if that would eliminate my interest in investing in it at that rate, but that would be my biggest challenge here, which you obviously state in your research. But yeah, I think it's interesting. It's just the creator economy in general has been lackluster relative to how much has been invested in it. I'll put it that way.
Yeah, so to build off what Scott was saying, when I first saw this opportunity, just think about YouTube creators as a profession. Go back a little more than a decade, right? And saying, I'm going to grow up and create a business built on your YouTube channel was almost completely unthinkable, unheard of at the time, right? Now I talk to my nieces, my nephews, like kids these days, they look up to this. They're like, I want to be a YouTube creator. I want to create a business like Mr. Beast. And I think up to date, there probably hasn't been a lot of capital and financing available to those creators. So to Scott's kind of point of what is the potential really good upside opportunity of this? If they become kind of the go-to community, right, that ecosystem around being able to both finance and provide capital to those creators to help them grow, and helping the the investors to be able to get revenue share and share in some of that upside potential, I think it becomes pretty interesting. And even just on the whole tokenization thing, going back to one of our topics, from 2 weeks ago, they have approved, I believe, or they have applied for broker-dealer entity, and they are basically creating these channel revenue tokens, CRTs, which is kind of another innovative way of being able to just distribute these revenues at scale, right, to all of the holders. And they talk about digital ATS, that's an alternative trading system, which would essentially talk about thinking about the future of a secondary market to allow these tokens to trade. So they're doing a lot of interesting things for sure. I think, to the point around the valuation, it's definitely something investors need to consider, of if that risk versus reward trade-off is right for them and for your own goals. But it is pretty interesting from all those perspectives. Leia, anything else in terms of just, your assessment of this and when you were taking a look at it before we drop off?
Yes, you just said something very interesting that after a 12-month holding period, investors in these YouTubers can start trading. I have no idea how that's going to pan out. Are we going to see actually a demand for these shares? Are we going to see the share value increase? But it can be interesting because not only investors in YouTubers are getting revenue, but there also is a direct opportunity to resell your investment. Obviously, this is brand new. This is extremely risky. I feel like anybody investing in these YouTubers should put probably a very small amount of money or be willing to leave it all. Because what if that YouTuber just decides to stop YouTube? But I think that I would love to learn more if there's an opportunity to talk to them about what are the long-term growth paths, because I feel like if they can open it to Twitch, Instagram, TikTok, there are many investors that could be interested in following the development of young creators that have a lot of potential on these platforms.
The one other thing I'll add too, so from the Kingscrowd page, advanced search, if you just sort by Gigastar, sorted this by amount raised, they've had some pretty successful creators already raised, right? So Mr. Hand, and the other thing I noticed is a lot of the most successful ones come back for multiple rounds. So Mr. Hand did both his first and second kind of drop, which is like their token drop for their rev share. Clear Value Tax, I think, has done upwards of nearly 3 now. So a lot of people, when they have success, are coming back, which I think is also helping those creators to engage their community, to make their community just feel involved in their channel, and that potentially helps in the growth. So it's sort of, you get these monetary benefits of being backed by your community, by your supporters. But you also get some of the non-monetary benefits where those people are now your brand ambassadors, and they're probably going to go and tell all of their friends, all of their family and different networks all about your company, about your channel as well. All right. Unless there's anything else, I think we will call that a wrap for this week. So thank you everyone again for joining us for another Kingscrowd podcast. And just as a reminder, you can go and get a lot of these great free data-driven insights. Head over to kingscrowd.com, create a free account, get started, get on our newsletter so that you can also subscribe to this to be able to get all of these episodes each week when they go live. Until next time, we'll see you back here later.